Welcome to The Good, the Bad, and the Economy, and I'm your host, Napoleon Olarte. I want to shift today a little bit from the podcast episodes into something very important. It's about the inflation report for the month of August that came in this morning. The CPI report came at 8.3%, and without the cost of energy, it came in at 6.3%. Now, I want to break down these numbers a little bit. The first thing that we need to understand is that these numbers are just a comparison from last year. So what it means is that for the month of August 2022, consumer prices have gone up 8.3% compared to August 2021. That's all it means. Now, this 8.3% came a little lower, just 20 basis points from the reading in the month of July of 8.5%. This is significant news, and you can tell by how Wall Street reacted this morning and how stock prices went down. The Dow Jones is down over 800 points and the Nasdaq is almost 500 points lower as of the time of this recording, almost 11 a.m. West Coast Pacific Time. Another interesting stat is that the CPI, excluding food and energy, rose from 5.9% in July to 6.3% in August. Now, why is this important? It is important because the Fed has already increased the interest rates, hoping to slow down the economy in the last 3 meetings. But those rate increases haven't been completely diluted into the market. What we've seen is the government making an effort trying to lower gas prices. From the month of July to August, the drop has been from a few cents in some states to more than $1 in California. But one thing that we can be sure of is that gas prices cannot go down to zero. As I explained in one of the podcast episodes, we've seen that the gas prices have 4 elements built into it, and that is the price of crude oil, refining fees, distribution fees, and taxes. So gas prices will never go to zero. So why does this worry the markets? In essence, it's because if gas prices have already dropped some during the month of August, but the CPI has not gone down as expected, what do you think is going to look like next month and the month after and the month after when gas prices cannot drop much further down? So what the CPI without food and energy is telling us is that prices in the market are still going up and will continue to go up. If you have not watched the Fed comments last week, and not only from the chairman, I can just recall that the Fed will remain hawkish, and that's just a term to say that the Federal Reserve will continue to implement tightening policy. Yesterday, we also saw the European Central Bank increase its interest rates by 75 basis points. Now, the European Central Bank's chief, Christine Lagarde, said that rates are far away from levels appropriate to getting inflation back to target in a timely fashion, and that hikes should be anticipated at the next several meetings. My problem with the European Central Bank and the Federal Reserve is that these increases still accommodates policy at current rates. If they truly and really wanted to fight inflation, why they do not increase the rates by more than 75 basis points? Now, the Federal Reserve is going to meet in less than 10 days, and we're expecting 75 basis points increase again. That's what the market's anticipating. But the real concern is that if these increases are really high enough to make a difference over time, or maybe the Federal Reserve is just prepping us for a higher increase in the next FOMC meetings. I mean, the reason why I said that is because if currently CPI is sitting at 8.3% and the target inflation rate is at 2%, and still not only that European Central Bank, but here in the US, at the current rates, we're in an accommodative policy. If they really wanted to bring down inflation, if the Federal Reserve really wanted to bring down inflation, why don't they increase the rates, let's say 1.5%, 2%, or 2.5%, maybe 3% in the next couple of meetings? But if the Fed did that, the market will go into panic mode. If the stock market went down more than 2.5% today, based just on inflation not meeting their expectations, and that's a little bit irrational because all these people on Wall Street, all these economic advisors, they know that current inflation is going to keep on getting higher, and the Fed is not increasing the rate as fast as high as they should. Now, in my humble opinion, I do not want to be a big critic of the Fed. I believe that the Fed is doing a good job. If I were to rate the Fed, though, I mean, this is just my humble opinion, and I'm not one to, be rating anyone, the Fed actions. But if I were to rate the Fed or, the Federal Reserve in terms of rate increases in order to fight inflation, I would give them a 6, maybe a 7, because they're doing I think they're doing the right thing. Now, I also believe that they haven't increased or will increase the Fed funds rates as high as they should, like I said, 1.5, 2 or 3% in a meeting or for the next couple of meetings, because that would be detrimental. Imagine what would happen to the real estate market. There would be immediate margin calls from banks to institutional investors holding residential real estate. The market will react in a panic, trying to figure out what the Fed just did. And I believe that's the reason why the Fed has not gone full throttle into increasing the rates to the way that would make the economic slowdown they want for inflation to drop to their target of 2%. Let's keep an eye on what the Fed is going to do at its next meeting on September 21st and 22nd. For now, this is it. See ya.